China has been the world's manufacturing powerhouse for decades, producing everything from clothes to electronics, cars to machinery. But why? How did China ascend to this manufacturing throne? And now, what's disrupting its reign? The COVID-19 pandemic, rising costs, eco-rules, trade tensions, and geopolitics. What's their role in this story? Well, China's manufacturing industry has grown rapidly, contributing to over 28.7% of global manufacturing output. Factors like low labor costs, government support, a vast domestic market, and efficiency improvements through technology have all played a role in establishing China as a global manufacturing powerhouse. Recently, China's manufacturing sector has faced obstacles such as increasing labor costs, trade tensions with the U.S., environmental concerns, and disruptions due to the COVID-19 pandemic. These challenges have led to a decline in China's share of global manufacturing output. The Chinese Communist Party's politics, including forced technology transfer, market access restrictions, and political interference, have prompted many foreign companies to relocate their manufacturing operations from China. This shift has significant implications, including job losses and economic impacts for China, as well as potential disruptions and cost-saving opportunities for companies moving elsewhere. Hello and welcome back to the channel. Today we will uncover the secrets behind China's manufacturing supremacy and its challenges. Why did China become the world's factory? What's shaking up its manufacturing empire? And how will this affect our world? Get ready, because we're about to decode the compelling narrative of China's manufacturing saga. So without further ado, let's dive straight in. China's journey from a major player in global manufacturing scene in 1980, contributing just 2% of the world's manufacturing output, to today's world leader, responsible for over 28.7% of global manufacturing, is a remarkable transformation. China's manufacturing prowess spans various industries, from electronics and textiles to machinery and vehicles, profoundly influencing the global economy. Its exports have boosted worldwide economic growth and fueled its own economic development. A pivotal driver of China's manufacturing ascent has been its significantly lower labor costs compared to developed nations. This cost advantage attracted foreign manufacturers seeking efficient production. China boasts a vast and ever-expanding labor force, providing an abundant pool of relatively affordable workers. The government's investments in education and training further enhance the skills of this workforce. China's government played a crucial role by opening the economy to foreign investment and trade. This decision brought in foreign capital and advanced technologies, modernizing the manufacturing sector. The government also introduced export promotion policies, including tax incentives and subsidies for exporters, fostering growth. Substantial investments in infrastructure, such as transportation networks comprising roads, ports, and airports, streamline the efficient movement of goods to and from global markets. Thanks to its vast manufacturing capabilities across various sectors, China stands at the heart of the global supply chain. Its efficiency, scale, and export strength have made it an integral part of international supply chains. China's manufacturing dominance has had a significant impact on the global economy. On one hand, it has helped lower prices for consumers worldwide. On the other hand, it has led to job losses in developed countries as manufacturers have shifted their operations to China. China's manufacturing dominance is also having a significant impact on the environment. China is now the world's largest emitter of greenhouse gases, and its manufacturing sector significantly contributes to pollution. We're embarking on a journey through the intricate landscape of Chinese business, where companies navigate many challenges that profoundly influence their operations. Let's explore these challenges together, straightforwardly and engagingly. China was a go-to destination for companies looking to manufacture goods at a lower cost. This was primarily due to its abundant and relatively inexpensive labor force. However, as China's economy grew and the standard of living improved, labor costs rose. This meant that companies operating in China had to allocate more funds to pay their workers. This shift is making China less attractive for businesses seeking ultra-low-cost production. China has had a somewhat checkered history in the world of innovation and intellectual intellectual property, or IP. Companies, especially those from abroad, have expressed concerns about protecting their intellectual property within China's borders. IP theft and infringement cases have raised doubts about whether companies' valuable ideas, patents, and technologies would be adequately safeguarded in China's business environment. The United States and China engage in trade tensions. This ongoing feud has led to tariffs on goods traded between the two countries. What does this mean for companies operating in China? Well, it translates to increased costs. Companies often had to navigate the complexities of these tariffs, which affected their bottom line and prompted them to reevaluate their strategies for doing business in China. Beyond the realm of trade, the Chinese Communist Party, or CCP, has been exerting more control and scrutiny over businesses operating within China's borders. The influence manifests in various ways, including how companies are expected to operate and the types of products and services they can offer. The regulatory environment in China has also become more intricate and subject to change, which can be challenging for companies to navigate. Non-compliance with these regulations can result in fines and other penalties. The Chinese Communist Party wields substantial influence over businesses operating within China. This influence is primarily manifested through the requirement for all businesses to establish a party cell, consisting of CCP members tasked with ensuring the company aligns with the party's principles. Moreover, the CCP possesses the authority to appoint or dismiss directors within these enterprises, along with the ability to veto their strategic decisions. What makes these regulatory hurdles even more impactful is their potential to be employed as weapons rather than mere obstacles. The CCP has been known to use these regulations strategically, targeting and penalizing businesses that don't align with its interests or preferences. In the ongoing saga of business in China, the CCP's influence is a silent yet ever-present character. It shapes the destiny of businesses, adding layers of complexity to their operations. The intricate relationship between the party and businesses continues to evolve, mirroring the shifts in China's dynamic economic landscape. In the backdrop of business operations, concerns over human rights have emerged as a critical issue. There have been allegations of human rights abuses in China, including reports of forced labor among Uyghur Muslims in Xinjiang province. These allegations have led to calls for companies to take ethical stands, with some facing pressure to either boycott or divest from China to avoid association with such issues. Enter the global pandemic, COVID-19, which profoundly impacted supply chains and manufacturing in China. As the pandemic spread, China implemented lockdowns and faced transportation disruptions. These factors resulted in shortages of essential raw materials and components, causing delays and disruptions in production. Companies worldwide felt the ripple effects of these disruptions, highlighting the risks associated with relying heavily on China for global manufacturing. In response to these challenges, some companies began exploring strategies to diversify their supply chains and reduce their dependency on China, ushering in a new chapter in the business in China. China reigned as the world's undisputed manufacturing hub, beckoning companies from every corner of the globe with its promise of low labor costs and seamless supply chains. It was a compelling tale, a narrative that played out for decades. But now, a new chapter has begun to take shape, an account of companies diversifying their manufacturing bases, seeking new horizons beyond China's borders. And so, the manufacturing landscape evolved. Companies embarked on a quest to find alternative manufacturing destinations, diversifying their portfolios to build more resilient supply chains. The tale of diversification away from China had begun, reshaping the future of global manufacturing. Let's delve into the experiences of companies that have already embarked on this journey. Apple, the tech giant, has shifted some of its production from China to countries like India and Vietnam. Samsung, another tech heavyweight, has been moving portions of its production out of China with a keen eye on Vietnam. Tesla, the electric vehicle pioneer, is building a new factory in Germany and contemplating expanding into Mexico. Toyota, a stalwart in the auto industry, is moving some of its production from China to Mexico and Thailand. General Motors, a titan in the car world, is shifting production from China to Vietnam. Nike, the iconic sportswear brand, is diversifying its production from China to Vietnam and Indonesia. Adidas, a global leader in athletic wear, is also relocating production from China to Vietnam and Indonesia. H&M, the fashion retail giant, branching out from China to Bangladesh and India. it's essential to weigh the potential benefits and challenges of this relocation. Reduced costs. Some countries offer lower labor costs and incentives, enhancing cost-effectiveness. Reduced risk. Diversifying manufacturing minimizes the risk of disruptions, whether due to geopolitical tensions or natural disasters. Market access. New manufacturing destinations open doors to untapped markets, expanding a company's reach. Increased costs. The initial relocation costs can be substantial, including facility construction and worker training expenses. Supply chain disruptions. Transitioning can disrupt existing supply chains, leading to delays and cost escalations. Quality control. Maintaining consistent quality can be challenging, with operations across multiple countries. The decision to relocate manufacturing operations is complex, deserving of a case-by-case examination. Companies must carefully weigh the potential benefits and challenges, like characters in a carefully crafted plot, before making pivotal decisions in this ever-evolving narrative. If companies continue their departure from China, it could cast a shadow over the country's economic landscape. Here's how the plot thickens. Foreign direct investment, or FDI, has been a cornerstone of China's economic growth. Should companies begin to invest less in China, it might cast a pall over the nation's economic prosperity, potentially leading to slower growth. The manufacturing sector in China is a massive employer, with millions of people relying on these jobs. If companies relocate their manufacturing operations elsewhere, it could translate into a significant loss of livelihoods, painting a sad picture for the Chinese workforce. China's position as the world's leading exporter of goods could be at risk. If companies start shifting their production hubs away from China, it may result in a drop in Chinese exports and a surge in imports. This could send ripples through the Chinese economy, affecting trade dynamics on a global scale. The exit of companies from China has far-reaching consequences, akin to a domino effect in the intricate web of global supply chains. Companies opting to relocate their manufacturing operations must seek out new suppliers and markets. This transition could cause disruptions across global supply chains. Additionally, businesses may need to rewire their supply chain strategies to make them more resilient in the face of future disruptions, ensuring the story of supply chains continues with agility. The departure of companies from China could send shockwaves through global trade patterns. For instance, if businesses shift their production to Southeast Asia, it might stimulate increased trade between this region and other parts of the world, sparking positive and negative consequences on the global economy. Countries reliant on Chinese imports, like the United States, might be rewriting their trade narratives. Exiting companies from China could set off geopolitical reverberations, rearranging the pieces on the chessboard of international relations. Companies venturing beyond China's borders may explore new business horizons, striking deals with countries like India, Vietnam, and Mexico. This could lead to reshaping alliances and trade partnerships on the global stage, painting a new geopolitical landscape. China will likely play its hand strategically in response to losing its manufacturing dominance. This might involve enticing incentives like tax breaks to lure companies back or retain those still considering an exit. China could also adopt a more assertive foreign policy to safeguard its economic interests, potentially rewriting the script of global diplomacy. Companies embark on a quest to diversify and reduce risks. Here's a glimpse of their strategies. Some companies consider reshoring, bringing manufacturing back home. Others opt for nearshoring, moving production to nearby countries. These strategies offer a way to lessen dependence on China and safeguard against supply chain disruptions. Another path is showing production facilities in alternative countries. Popular destinations include Vietnam, India, and Mexico. This expansion to new territories helps companies spread their manufacturing wings. China, aware of the changing tides, prepares its response to retain foreign businesses. China may enact policy reforms and regulatory changes, sweetening the deal for companies to invest in manufacture within its borders. Tax reductions and simplified regulations may be part of this strategy. China recognizes the importance of an inviting business environment. Efforts may include infrastructure improvements, anti-corruption measures, and robust protection of intellectual property rights. Beyond these strategies, there's potential for collaboration. Companies and China can work together to address underlying issues, such as geopolitical tensions and supply chain vulnerabilities. Remembering that there's no one-size-fits-all solution in this intricate tale is essential. The right strategy for each company depends on its unique circumstances. As the narrative unfolds, systems will evolve, shaping the future of global business. China's rise to manufacturing dominance has been a remarkable journey, fueled by factors like low labor costs, government support, and a vast domestic market. However, recent challenges, including rising costs, intellectual property concerns, and geopolitical tensions, have disrupted this dominance. Companies are now diversifying their manufacturing bases, seeking resilience and reduced risk. This shift has far-reaching implications for China's economy, global supply chains, and geopolitics, requiring strategic responses from companies and China. As this complex narrative continues to evolve, adaptability and collaboration will be crucial for success in the ever-changing landscape of global business.